I mean, I don't know how much more obvious the Fed could be here that there's a problem. And Wall Street is just ignoring this. And that's fine in the near term. But as you've probably heard before, the chickens will come home to roost at some point in what could be the not so distant future. Now that the Fed's blackout period is over, the FOMC meeting happened last week, we are starting to get a bunch of Fed speakers that are all of a sudden trying to justify their 50 basis point rate cut as a positive, when in all actuality, if you understand economics on a deep level, like myself and some of you guys, then you can see just how troubling some of the things they are saying actually are. And we will cover that here in this video. We had Fed Kashkari, we had Fed Austin Goolsbee, but I actually want to start with this. We got the S&P Global Composite PMI, Manufacturing PMI, and Services PMI this morning. And take a listen to this segment on employment and capacity. It says employment fell for a second month running in September and has now fallen in 4 of the past 6 months. That said, the overall decline was only very modest and less than reported in August amid reduced job losses in the services economy. The decline in service jobs was often linked to difficulties replacing leavers, though the addition of new staff was cured by uncertainty around the outlook. Manufacturing payrolls, now this is nasty, were meanwhile cut at a pace not recorded since June 2020. Excluding the pandemic, the decline in factory jobs was the steepest since January of 2010. As an increasing number of firms reported the need to reduce operating capacity in line with weak sales. Okay, now that is not anything you will hear from anyone on Wall Street. So basically, if you have a factory job, look out, because layoffs are really starting to accelerate. And if we're starting to really make comparables to the ending of the great financial crisis around 2010, how strong are things actually? Well, unfortunately, I don't think we get much of an insight to the economy via government data, and the Fed is not very honest with us either. So the only thing that we can really rely on is corporate America, because corporate America is the only segment that markets care about that has to legally be honest with you. The government, there's no ramifications to lying to you. The Fed, it's actually incentivized the Fed lies to you during times of crisis or problems. Corporate America, on the other hand, will go to prison if they lie to you. So I think earnings season is going to be the biggest tell of all, and apparently factories are slowing down, and well, as a consequence to that, layoffs are starting to ramp up. Goldman Sachs says today labor supply growth is running around 150 to 180,000 per month, with monthly job growth running closer to 120,000 recently. It's a close call whether labor demand will prove strong enough going forward to fully absorb new entrants. The path ahead for the unemployment rate remains more uncertain than usual. So Goldman's basically saying that people are entering the labor market about 150 to 180,000 per month, but we're only actually adding about 120,000 jobs. So there may be 30 to 60,000 people a month that are just not able to get jobs, which this is one reason why Jerome Powell last week made it very clear that they do not want to see a continued drop in job openings. Because imagine it like this, if there's still that 120 to 160,000 people trying to enter the workforce, or 180,000 trying to enter the workforce, if there is less job openings, then that means your unemployment rate directly will start to be affected by the job openings number actually continuing to come down. And unfortunately, it's not looking like it's going to stop. You've been on a pretty consistent downward trajectory for job openings ever since March of 2022, when we peaked at 12.2 million. Now sitting at just 7.67 million. Pre-pandemic, you were at 7.1 million job openings. So you're getting back to where you were in January of 2020. Now, I think what's equally as confusing, or what could be just scary outright, Liz Ann Saunders, she is the chief investment strategist at Charles Schwab. She writes on X, the last two times the Fed started with a 50 basis point rate cut, 3-month and 10-year Treasury yield spread was either already in positive territory or in the process of uninverting. This time, spread remains deeply negative. So what this means, in simple terms, is you are still getting paid more for borrowing on the 3-month Treasury, right? 3-month yield curve, the short end of the yield curve, rather than the 10-year yield curve. It's saying in English, just translation, the bond market thinks the Fed is behind the curve. The bond market says the Fed needs to cut a lot faster than they are anticipating their cuts to be. This is a troubling sign. But I think what's even more scary than that is what Fed Goolsbee said today. Fed Goolsbee said today, quote, the economic data is somewhat delayed. If you want a better understanding of real-time data our connects are giving us, just read the latest Fed Beige book. I've read this Fed Beige book many times to you, maybe 2 or 3 times here on this channel, but I will read the first 2 sentences that explains why the Fed is starting to panic right now. Quote, overall economic activity grew slightly in 3 districts, while the number of districts that reported flat or declining activity rose from 5 in the prior period to 9 in the current period. So you went from 5 districts reporting declining activity in July to 9 reporting declining activity in August. That is a rapid pace of economic deceleration. And what you tend to see when you go into a recessionary cycle is growth slows down first. Companies try to hold on to labor because the last thing you really want to do is fire a bunch of employees if the economy gets better and then you need to hire again. Like, that doesn't make a whole lot of sense. And then once the economy weakens to a certain extent, which I think we're approaching that cliff, if you will, that's when the layoffs actually start. So from that standpoint, it could already be too late. If truly Austin Goolsbee is correct and the economic data is delayed, in which that's also my view. And that's Austin Goolsbee basically saying the economy is weaker today than what the economic data says. Now, Fed Goolsbee also says a 0.7% increase in unemployment over a year is usually a warning sign of recession, which is what's happened already. Fed Goolsbee said it's a little bit of a cautionary period. Fed Goolsbee says there are going to be many more cuts over the next year, and that labor market deterioration typically happens quickly. And again, something I've pointed out here on the channel a lot, many times now throughout this last couple of weeks. If you look at the unemployment rate and overlay that with the federal funds rate, typically the Fed is raising rates into an unemployment rate that is actually falling. That did not happen this time around. And typically when the unemployment rate starts to rise, it continues to rise. So any instances of an actual soft landing, the unemployment rate was falling when the Fed started cutting rates. Okay. This time, the unemployment rate is rising as the Fed is cutting rates. That's not very supportive of the soft landing argument. And even during times in which we did have, harder landings, like the 90s, right? The unemployment rate rose, but it didn't rise that aggressively, okay? It rose from 5% to 5.4%. as the Fed was, cutting rates. So it did rise, but not that aggressive. And the Fed was cutting rates, and it was still not enough to save the economy. Same was true in the early 2000s. The unemployment rate hit a low of 3.8%. It rose to about 4.2% as the Fed started to cut rates. It was still not enough to avoid a recession. Back in 2007, 2008, unemployment rate hit a low of 4.4%. Right before the recession, you hit about 5% unemployment. And the Fed was cutting rates. In the prior, 3 months or so until we were declared in a recession, and it was still not enough. Now the unemployment rate has risen from 3.4% up to 4.3%, and now the Fed's starting to cut rates. If history repeats itself, it's already too late. Another big problem that Wall Street will not talk about is the potential for a housing market reset, something much larger than what we have seen over, certain demographics. And I know commercial real estate's had its issues, apartments have had their issues, big ticket homes have had their issues, but not really single family homes yet. Take a look at this. From February of 2022 until today, there is 3 times more houses that are currently listed on the market, going from 346,000 in February of 2022 up to now 909,000 homes that are listed in August of 2024. Simple supply and demand pressures would say that if there's more supply and that supply is not offset by increasing demand, prices will come down. Now, there's not an exact science to how fast prices will come down, but inevitably, prices will come down. And I really haven't heard anyone talk about this and what kind of effect this could have on the economy. Just imagine where the economy would be right now if the housing market starts to fall out of bed. I mean, most people's or most families' net worth, the largest chunk, is in their home. If they start to see their home values fall, that psychologically tends to be something that people don't like, and they stop spending as much money when that happens. Now, if the Fed does cut fast enough and they're able to lower rates quick enough before, people start to lose jobs in larger numbers and they're actually unable to buy a new house, then that is a potential upside surprise for the economy. But it looks like the unemployment dynamic, the weakening in the labor market, is outpacing the quickness that the Fed is actually cutting rates. Even though they cut 50 basis points, it's just not fast enough. And we do have the 3-month yield curve inversion that is telling us that as well, like we previously discussed here in this video. I actually find it interesting as well. A lot on Wall Street are starting to say, don't fight the Fed, which is a very interesting term. Now, if you've been in markets for many years, like I have, you've heard this terminology thrown out many times before. Don't fight the Fed. When the Fed is raising rates, you probably don't want to be in equities. When the Fed is cutting rates, you probably want to be in equities. But in fact, it's historically the opposite. Historically, fighting the Fed actually means when the Fed is cutting rates, you don't want to be in stocks. Because when the Fed is cutting rates, there's a problem. The economy is weakening, and that's going to put pressure on corporate earnings. Actually, historically, when the Fed is raising rates, you want to be in equities. Like perhaps the late 80s, when the Fed was raising rates from 1988 through 1989. The unemployment rate was falling. Economic activity was just fine during this time. And then the Fed started cutting rates, and by 1990, you were in a recession. Same is true back here when the Fed started really raising rates 1994 through about 2000. 1994 to 2000 was a pretty damn good time to be an investor in the markets. Unemployment rate was falling, Fed was raising rates, economy was doing just fine. You made a lot of money if you were investing when the Fed was raising rates during this period. It's actually when the Fed started cutting rates that you wanted to be out of markets. Now, same is true for the period of 2004 through 2007. Right? Until the global financial crisis or great financial crisis, whatever terminology you like to use, happened, the unemployment rate was falling. The Fed was consistently raising rates, almost in a straight line trajectory, and stocks did very well, exceptionally well during this period in time. It wasn't until the Fed actually cut rates that you wanted to get out of markets. Same is true in the most recent historical precedents from 2015 through 2019, when the Fed was raising rates, unemployment rate was falling. You wanted to be in markets during this time. And then what happened? The Fed started cutting rates late 2019. It was probably a good time to start reducing some stock exposure. Even though we didn't know the Rona was coming just a couple of months later, still, if you followed this historical precedence, you likely were served very well. You probably got a better buying opportunity during the Rona crash. And now that brings us to where we are in the present day. Markets wanted to fight the Fed on the upside. When the Fed was raising rates, stocks went higher. Generally speaking, in 2023, after the recession fears we had in 2022, that actually makes sense. Historically, markets should go higher when the Fed raises rates. That's because if the Fed is raising rates, corporate America is probably doing just fine. The economy is probably doing just fine, and earnings are probably growing just fine. And, well, if the unemployment rate is rising, coupled with the Fed that starts to cut rates where we are now, one, it's not something we see all the time, right? We usually don't see a rise like this in the unemployment rate and the Fed wait this long to start cutting rates. So that's pretty abnormal in and of itself. But usually when the unemployment rate rises and the Fed cuts, that's actually your moment where you don't want to fight the Fed. You don't want to be going long on markets when the Fed's cutting. You actually want to follow the Fed. Fed cuts, you reduce exposure in your portfolio. If you are more of an active trader, if you're a buy and holder, buy and hold, do your thing, you're going to do fine over time. But if you're an active trader, if you're watching this video, odds are you're an active trader, then when the Fed cuts, you want to reduce exposure. Every single time, historically speaking, you buy stocks when the Fed raises rates and you sell stocks when the Fed cuts rates. It's as simple as that. Until the recession or weakness gets priced into markets, then you can go back into stocks. What I mean by that is if markets were pricing in a recession or, seeing a freak out like we've seen in 2022, it would probably be a good time to, yes, go into markets. But as stocks are at all-time highs, does this really sound like a good idea? No, absolutely not. And that's why I've done my best job possible here on this channel to warn you about what's coming. Because this is a fact. We are in for lower stock prices over the next period in time. Unless, well, this time is just totally different. The unemployment rate just magically stops going up like it never historically does. And the Fed is actually ahead of the curve, not behind the curve, which historically they never are. The only difference between the US and China, in my opinion, at this point, which if you did not see, the unemployment rates came out for China last night. People ages 16 to 24 that are not in school, their unemployment rate rose to 18.8% last month from 17.1% in July and 13.2% in June. The overall unemployment rate rose from 5.2% to 5.3% from July to August. So China's basically collapsing. And the only difference between the US and China is this. We spent a lot more money. We printed our way out of a crisis. China did not. So the US prolonged its downturn and had higher inflation as a consequence of spending more money. China's feeling the downturn a lot faster than we are because they did not print as much. But they also did not see the kind of inflation that we've seen. In fact, China's struggling with deflation. Yeah, opposite, I guess, policy actions towards the COVID crisis, but we're all heading in the same direction. We're all heading to the same outcome. And we can see what's happening in China and forecast what's going to happen over here, and it's not pretty. Now, I think whether or not we have like an 07, 08 style, deeper recession do we get a black swan event? Do we get a 2 standard deviation black swan event? That could be something more than, Kmart going bankrupt. That could be larger company going bankrupt, or some kind of shock earnings report from Nvidia that's really bad, or Walmart that's really bad, that warns about the consumer. Something that is not likely to happen, but not too unrealistic to happen at the same time. It's not a total black swan event, right? That's like a 6 sigma event or 4 or 5 sigma event at the bare minimum, but like a 2 standard deviation black swan event, if we can call it that. This could be another bank of, First Republic Part 2 that goes bankrupt or something along those lines. Could be what pushes us into a deeper recession. Now, Fed President of Minneapolis, Neil Kashkari, says his SEP rate projection aligned with the median submission that had 50 basis points lower last week and another 50 basis points more through 2024. And this was a guy that was pretty dang bearish or hawkish or I guess, if you will, the economy is just fine just a couple of months ago. Something dramatically just shifted at the Fed that changed their views dramatically. So let me know your thoughts on this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a fantastic rest of your day, and I will see you in the next one.